future. We're talking real money.
Well, it's talking real money time again. We're always here talking real money. But what we try to do is we try to talk about money quietly. Quietly, sensibly, logically, without all of the confusion, the craziness that you hear so much of the time. As a matter of fact, Wall Street media, the financial press, is mainly just a bunch of noise. Now, I've been hosting financially oriented talk shows for about 35 years. One of the early believers in no-load funds, then a guy by the name of Paul Merriman, told me all about this wonderful way of investing that is academically based and, coincidentally, a whole lot less noisy. It just makes sense. And the kind of investing that we're talking about, we have been proponents of for decades now here on Talking Real Money, and that is the academically based approach that is used by the pioneering firm in this space, and that firm is Dimensional Fund Advisors, the DFA. And we have been huge proponents of DFA funds, and they've been huge friends of ours with incredible educational resources that we've used for years, and really some incredibly brilliant people. And I'm just thrilled to have two of the most brilliant people at DFA, the founder and the chairman of the board, David Booth, and the co-CEO of Dimensional, Dave Butler, on the show. We don't have guests very often, but when they come this special, we have them on. Gentlemen, thanks so much for being a part of Talking Real Money. Welcome to the show.
Well, thanks for having us.
Thank you.
Yeah, I look forward to it.
Now, you guys, the reason we talked about noise is a couple of years ago, there was a feature-length documentary produced by one of the finest documentarians out there, Errol Morris, about dimensional funds, and it's called Tune Out the Noise. David, tell me about that.
Well, we'd actually approached Errol with the idea of helping us, with communication and so forth. The basic premise is if we can make people or help people understand better how markets work, then they're more likely to come up with sensible solutions. And if they come up with more sensible solutions, they're likely to stay with the program. And if they stay with the program, then they'll get the benefit of the magic of compounding over time. That's a mouthful, but yeah, so it's more about education. And for some reason, here's a filmmaker, Academy Award-winning filmmaker, and he really got into it. He wanted to make it his film.
And thus, the film is out now. We've seen it as advisors about a year ago, but now it's available on YouTube so that anybody can watch it.
Yes, that's right.
Tell me a little bit about first the film and what fascinated Mr. Morris about the process at Dimensional. What was it? What was the impetus for him wanting to turn this into a full-fledged documentary?
Well, that's actually interesting. I asked him that question because it was kind of unusual that he would get so fired up about it. And he said, well, you're all such a quirky group.
Yeah.
And I think if you watch the film, you see, these people, in the film, 3 of the future Nobel laureates were in there. And you can see they're just kind of normal people other than they're brilliant researchers. So, that's their stories are what make the film interesting.
But now you started, David, you started Dimensional Funds when?
1981.
1981. And your thinking came about because of what? Why did you want to do this different way of investing? And we'll talk about why it's different in a bit.
Well, I went to the University of Chicago, and that's where everything changed for me. It was just a hotbed of excitement. This revolution in finance that was going on, one of the centers of that was clearly the University of Chicago. And I worked for Gene Fama there as a research assistant, and he's the person that coined the term efficient markets. And while I was there, I was like, oh, wow, this stuff is way too important. It's great that academics are debating these topics and so forth, but that can change the world. I mean, people are paying way too much in fees and, poorly designed portfolios and too much turnover. I want to go out and apply the ideas rather than sit around and try to dream up the next great idea. So that's why I left school, and eventually it led to Dimensional. And that's really been the excitement of Dimensional, is taking these ideas, and we often say these ideas are bigger than the firm itself, figuring out how to apply them and implement them in the best way possible.
But what sets Dimensional apart from just index investing? Because you could have just been an indexer like Vanguard.
Right. Well, there are a couple of things. First is, there are all kinds of indices out there. I mean, how do you structure a portfolio? And here again, we've been working closely now with 5 Nobel laureates, so we keep in touch with the latest in academic research. And so the first point is, I think we can structure portfolios, or design portfolios better than others. And the second part, and this goes largely unnoticed, has to do with the implementation. One of the principles of economics is that flexibility has economic value. Indexing is rather mechanical. It kind of avoids flexibility. It has one objective: track gosh darn index. Mm-hmm. And to do that, you have to have rather mechanical rules. And we come along, one of them, for example, if you want to buy a stock today in a stock index fund, you wanted to buy it at today's closing price, because that helps you track an index better. Well, you'll be buying at the closing price along with every other index fund that's out there that's wanting to buy it at the closing price. And we say, well, that doesn't make any sense. I mean, it's everybody rushing for the door at the same time.
It's the same stock.
Yeah, it's only so much to go around at any one point in time. So he said, well, we'll develop a skill in trading. And there are any number, we could go on, the whole broadcast, we could talk about all the little things you can do to add a little bit of value over indexing. Kind of an empirical question. Is that true or not? And when we started out, it was a claim we asserted we thought we could add value. People said, well, how do you know? How do we know you can do it? So they gave us small amounts of money. And then over time, we were able to demonstrate a value added over indexing. And that's what created really the great growth in the business.
Now, prior to that, though, you didn't have absolute evidence that your ideas worked, but you did have some research data from which to base those assumptions.
No, not only do we have research data, our first fund was a small cap fund. And in those days, and our first clients were large institutions, large pension funds, insurance companies, and so forth. And what we were able to point out to them is that they weren't holding the stocks of smaller companies. And any reasonable person, if you're thinking about how to form a portfolio, you'd want stocks of large companies and small. You wouldn't want to have just all your money in large stocks. And people said, well, that's true. So we said, well, we'll give you access to small companies. Because the reason you don't have small cap stocks is it doesn't pay for money managers to do all the research, on small cap in order to, pick the winners. So it's just not economic for them. For us, it's we can easily deliver and give you access to small stocks at very low fees, and that was even before we had data. So that's the only reason I was jumping in on the data part. And then we had data, and even there, people would say, "Well, why don't you show me the data?" I go, "Well, I don't want to. I mean, you believe the story."
I don't want to.
Yeah.
Yeah,
you believe the story. I mean, beliefs are better than data any day of the week, Yeah. So we had an overwhelming idea, and here again, the only potential snag was, how do we know you can trade these things? I mean, because small companies are rather illiquid, thinly traded, how do we know you won't just get your eyes ripped out? And we said, well, we don't know. We'll give it our best shot. And
and one of the reasons, though, I think, at least it helped initially, was the fact that when it was founded, Dimensional was a firm that only catered to larger institutional style clients. Is that right?
Right. And that made it, eventually we started working with advisors, and we had the ideal fund set up because institutions are always beating you down on fees. So we had, really well thought out funds with good track records, monitored not only by these institutions, but also our independent directors were all leading academics. So those are two groups that are tough to please.
And to that academic point, David, for you guys over the years, I mean, you mentioned it. You've worked with working with five Nobel laureates. Now, just to put that in perspective, most people don't know how many Nobel laureates there are. There have been less than 100 in the history of the Nobel Prize. You got 5% of them.
Oh, there you go. Well,
how? Why?
Well, it goes back to, because we hold in our small cap portfolios and our funds, basically we buy about 10,000 stocks around the world. And so every portfolio we have, we specialize in, you think of them as market portfolios, small market, value market, where you have hundreds or if not thousands of stocks in it. Well, you don't want to do that with an individual portfolio. I mean, if you have $1 million to invest, you don't want to buy 10,000 stocks. So we wanted to create a mutual fund, and that's been the cornerstone of what we do. And now ETFs. And when we started to go get that fund registered, we found out we had to have an independent board of directors that monitored what we do, totally unrelated and unaffiliated with us. So the only people we knew were leading academics. So we went over and, Merton Miller was the first person we saw. And Merton got his Nobel in 1990. We said, we need you to help as an independent director. He said, okay. And then
sure, why not? What the heck?
And we walked out the door, and coming down the hall the other way was Myron Scholes, of the Black-Scholes option pricing model fame, who got his Nobel Prize in 97. And said, Myron, again, we need an independent board. And Myron goes, well, how much are we going to get paid? And I said, well, Myron, it turns out we don't have any money, and you're supposed to be independent. We can't pay you anyway. But if the fund gets up and running, the mutual fund will pay directors' fees. He goes, okay. And so forth. And
so they did it for free initially.
Yeah, they didn't even know.
Yeah, good for them.
Well, that's important because they did it because they believed in what we were doing, and other people weren't doing it. So, for a period of time there, we were the only shop in town, so that was really important to us.
We are a very binary species. We tend to think in blacks and whites, human beings. We're lousy at gray. You guys are really a very gray firm. You live in the gray areas. It's not always good or bad. It's gray. It depends. I have and Dave, this is for you. Dimensional funds hold themselves out to be active mutual funds. They're promoted as such. However, really when it comes to investing over the years, there have been two primary definitions of active and passive. Passive is indexing. Active is picking stocks and timing markets. Where does DFA fit in that continuum between active and passive? You're not active in the sense that you're picking stocks and time and markets.
Right. Well, I think this goes way back to the history of this firm, Dimensional, 1981. Even prior to that, when you look at the academics and David and Mac McQuown and others that were involved in the early stages of what we now call indexing, that was in the 50s and 60s at University of Chicago, and there was a lot of data. They got their hands on big computers, and they were able to recognize that this classic approach of active management, stock picking, market timing, et cetera, didn't work, didn't add value. So they were really the original indexers, if you will, in the early 1970s. David and Mac at Wells Fargo and Rex Singfield at American National Bank. That was the kind of, I'll call it the indexing movement at the time. And what the story of Dimensional really is we want to take the foundational aspects of indexing, diversification, low cost, tax efficiency. That's what we do. But we want to recognize also that being hamstrung by an index composition and trading, as David pointed out earlier, trading on certain days with certain kind of illiquidity pressures and so forth, that's problematic for a fund from a total return perspective. So what Dimensional's really done, and going back to your question, active means we're daily implementation. We have flexibility in terms of how we trade. We take all of the good things about indexing, and then we add daily implementation, flexibility, and some of the things that we think are special and helpful to the end return for a client. So when you look at our kind of track record and history now, and David pointed that out earlier, we have 20 years of funds, equity and fixed income funds that have beaten indexes. 84% of those funds have beaten indexes. The average active manager, that number is 17%. So when you talk about the track record and the implementation, it really comes down to that. If, as David always points out, we would not have a firm if we didn't implement better than everybody else, and if we weren't able to add value above and beyond indexes. So that's really been our story from day one. And sometimes labels of active versus passive get confusing to people. But I think it's really just the key cornerstone kind of concept is we take all the best of indexing that we just mentioned, diversification, low cost, tax efficiency, and then we add value from a flexibility and a trading perspective. And also, again, to Dave's point, is identifying certain areas of the market, certain premiums that show up in the historical data, and we try to deploy our capital and buy stocks in those areas in the most efficient way possible. And we think there's a value add in that as well.
Okay, you got a whole building full of PhDs down there in Austin, and in California, and in Charlotte. Can't you get these guys and gals together to come up with a new term between active and passive?
Well,
we need a new word.
Well, I'll buy anybody dinner that can come up with a better one. We've struggled with that for 43 years now. Yeah. Basically, I'll just add, I don't think there is such a thing as passive management. I mean, you got to make choices. If nothing else, you got to do trades, and how you do them makes a big difference. And you vote the proxy, all the proxies, and there's a lot that goes on into portfolio management that's not related to picking winners. And so, an example would be, if you look at the Standard & Poor's 500 index, that's the index that probably has more index funds chasing it than any other. When a company leaves the index and they need to add a name, the committee sits around and they kind of look at each other and go, what do you like? Here's a group of stocks, the next largest stocks that aren't in the index. Which ones do you think we should add?
Yeah, that's an active decision right there.
Yeah, right. So I don't think an S&P and 500 index fund is passive.
Now, over the years since you started Dimensional, David, and since you've been there, Dave, the industry has dramatically changed. I mean, I remember when I was a broker back in the 80s, no-load funds were practically unheard of. Index funds, nobody was doing. Everybody believed in active management, in stock picking and market timing. That has finally flipped to where less than half of the market is traditionally actively managed in the mutual fund arena. Where do you think this is going to go, and why do we still have so much active, given the fact that the numbers are so bad? Either of you.
Well, I'll go back to my start at Dimensional, 1995, so 30 years ago, and we were, the number that was quoted at that time was low single digits. So I think 3 or 4% of the assets were indexed at that time when you looked at the Morningstar mutual fund book, if you will. So today it's...
And it was a book, by the way, folks. It was a big, thick notebook I sat and leafed through.
and today it's up over 50%, to your point. So the movement has progressed. The movement is pretty has been methodical. I think it's as Gene Fama points out in the movie, how do you explain it? Well, you look at the data, and the data suggests that it doesn't make a lot of sense to pay high fees for something that doesn't seem to deliver value beyond chance. And I think that's been the kind of the mantra in the story, particularly even in the advisor space. We've seen a movement in that direction over time. When I first started in 1995, I spent most of my time with advisors talking about why Morningstar star ranking didn't really suggest any kind of performance going forward, or we talked about a certain active manager that had a great run for 2 or 3 years, and why that run might not continue. And now when you walk into an advisor's office, it pretty much is table stakes. People say, yep, diversification, yep, low cost, yep, tax efficiency. And then you get into the kind of some of the more wealth management oriented topics. So the mindset has shifted completely. I still think, people just naturally have emotions, and those emotions are, two big emotions are fear and greed. And, people think and like the idea of going out and trying to find a great manager or finding a great stock and that sort of thing. So there's always going to be that natural emotional bent to try to outperform. The main thing that we always try to, caution advisors and caution clients is that, you want to, focus in on the data and the statistics and what suggests a proper policy, investment policy is for that particular client, and stay with it and avoid kind of the emotion that comes, the fear and the greed that comes with the market movement each day, like we're seeing right now.
I think the movement to passive management has been dramatically overstated. Over the last 30 years, as David pointed, there's been an explosion in the amount of money invested in index funds. There's also been an explosion in trading volume of stocks. So how do you explain that? I mean, if you index funds, one of the reasons you go to them is because they have low turnover. So here you have a situation where the growth in indexing has been associated with a growth in trading volume. It says to me that people are not buying it for passive management. They're buying it because they think they can time index funds, indices.
So they're just broad market timing instead of individual stock timing.
Yeah, right. I mean, I think I don't know how else to explain it.
So you're not worried that the like many pundits in the noisy media, you're not worried about the argument that indexing will eventually destroy indexing?
No, not in my lifetime.
Well, speaking of lifetimes, Dave, the industry over the past 100 years has changed dramatically. I mean, 100 years ago, we barely saw mutual funds. They were closed in. They were hard to buy. They were incredibly expensive, complicated, convoluted. And over a very long period of time, the mutual fund industry grew. It was still expensive. And then suddenly in the 80s, really, the 70s and 80s, it exploded. And now we have mutual funds and we have exchange-traded funds, which Dimensional has gotten into in a big way. Where do you see this going from here? I know I'm not asking you to predict the market future, but the industry future. What do you think it does?
Yeah, well, I think that's what intrigued Errol when he made this movie. I think it's a story that really hasn't been told. And when I started in the industry, back in the late 80s, it was really about trading, and it was about high commission. It was high cost. It was high transaction. It was, as we used to say, the broker would look in their crystal ball and tell you what direction a stock was going to go or what direction the market was going to go. And then if they intrigued you enough, then you would trade on that security or trade on that idea, and they would make money. And that was the origin of that was a definition of investment advice when I started. I look back, I remember looking back at one of my personal trades. I actually made a $10,000 trade, and there was a trade ticket in my garage when I was clearing it out a couple of years ago, and it was a $500 commission on that $10,000 stock trade. So it was a 5% commission. So 5% in, 5% out. You're talking about 10%. So
pretty soon you're talking real money.
Yeah, right. So where we've gone from there to where we are today. So now we have investment advice, good investment advice, well under 1%. It's holistic wealth management. It's everything other than just the investment part. It's taxes, it's estate planning, it's charitable giving, it's family dynamics. All of those things are wrapped up into this offering now that is wealth management. So the offering to the client has gotten much, much better. The advisor knows the client very well. They understand the client dynamic. They're the expert in the client space. There's a separation between the advisor and Dimensional, or Dimensional is the capital market expert. The advisor is the client expert, and we think that's a really a good dynamic in the way things should be. And all that adds up to a much, much better client experience than we had 10, 15, 20, 30 years ago for sure. So things have gotten better. I think technology has been a big impact on that. Funds and ETFs and ability to trade at a very low cost. Custodial costs are very low. Things have gotten much, much more efficient. Now, the downside, and David and I have talked about this quite a bit, the downside of technology is that it also can lead to behavior that's not positive and helpful to a end client. So things like trading apps, things like the fact that David and I could sit here and trade a stock right now if we wanted to on our phone, that leads to some of the activity and trading and turnover and taxes and things that are not helpful to the end client. So technology can be a very, very positive thing from an investment perspective. It can also be a negative or detrimental in certain ways to client behavior. So I think one area that we really need to focus on and talk about going forward for clients is really the emotional and the behavioral aspects of their approach to the markets, number one. And then secondly, I think this idea of customization, and David talks about this quite often. Technology has allowed individuals to have much, much more customized investment solutions, and things like, we not only launched ETFs 4 years ago, but we also launched a separately managed account platform at $500,000 when our old minimum used to be $20 million. So technology has allowed us to actually offer the kind of,
because those trading costs are now so much lower than they used to be.
Trading costs are much, much lower, and the technology and the platforms that we've developed to actually be able to trade a portfolio, a customized portfolio at $500,000, that couldn't have happened, even 5 years ago. So those kinds of things are really good, and those customizations then allow an advisor to sit with a client and kind of work through various tax scenarios and estate scenarios that are really going to be helpful to that client at the end of the day. So things have changed quite a bit. I'm very positive, obviously, and optimistic about what I've seen change over the last 30 years, and I think that's going to continue on for hopefully the next 30 years as well.
Boy, would advisors love to find some behavioral emotional control for their clients. Maybe that's Neuralink. Maybe we're going to just have to bring them into the office, hook them up. All right, don't worry. Yeah. It's going to.
That's one of the things that David always says that the question is like, how are you going to make people feel okay? That's a line I've stolen from David over the year, and frankly, even the movie is really
it's the biggest part of the equation,
the biggest deal. So you got to keep working on communication. You got to keep working on things like the movie. Hopefully, people get more confident around how they invest and how they can stay in the market and be disciplined. Because look, if you can do all that, and I go back to my first interview at Dimensional with Merton Miller, happened to be in the hallway when I showed up to interview, and he went to lunch with us, and he said three things. He said, diversification is your buddy, markets work, and costs matter, and you throw in the fourth, which is discipline, and you're going to have a really successful investment experience if you can do those four things well. So that's a key, and that fourth one is the question, and that's where as you said, the advisor comes into play,
where the Neuralink comes into play. Yeah. Thanks, Elon. The question on ETFs. I know that Tom and I, as we've been doing this show forever, were reticent to suggest exchange-traded funds. We knew mutual funds. They worked well. They had 100 years of history behind them. And this new kid started up in part because of technology, the exchange traded fund, which is an evolutionary device of some sort, but we were scared of it. Were you scared of it initially, or concerned? Maybe not scared, but not convinced it was the right way to go?
Well, I think, one thing that David and I did 10 years ago, or probably about 15 maybe, we went around and we talked to advisors and we said, what exactly are you using in your practice? What do you need? What tools do you need to be able to deliver on the client experience? And it was very clear to us that ETFs were part of that package. So it was ETFs, it was mutual funds, it was some separate accounts. But we recognized that ETFs were part of that landscape. So for us, the Dimensional, the real trigger was September 2019. what they call the ETF rule that allowed custom baskets and allowed us to, in essence, trade in a very similar fashion that we do on the fund side. And that allowed us also to then add value in the ETFs category, ETF space, like we have done, had done over 30 or 35 years in the mutual fund space. So that was a big trigger for us. We could have launched indexed ETFs 10 years ago, but then to our point earlier, an index doesn't add value beyond an index. And we had built a business.
So you needed the ability to trade the way you trade in the ETF
exactly.
space.
And that was the key was September 2019 and the ETF rule, because that allowed us to do custom-based baskets and we could trade the way we had historically traded in the fund side. And that was a trigger. So we launched literally, I think it was 10 months after that rule came out. And then I think we're now probably 175 billion on the ETF side, and I think we're the fastest grower. We're number one in the active ETF space, et cetera, et cetera. So it's been a real positive, and I think advisors and their clients do appreciate the fact that we did launch ETFs and move into that business.
Before ETFs, Dimensional was really only a product that was available to clients of advisors. You could not, as an individual, in most cases, go out and build your own portfolio of DFA funds, correct?
That's right.
But now, how have ETFs changed that? Your relationships with end users, with customers, have they changed that?
No, it hasn't changed it at all. We went out with the idea, again, going back to the discussions with advisors, and we call it the feedback loop. We wanted to deliver the wrappers, the vehicles that they needed to be able to deliver on their client experience. And so that's what happened. And we were confident that was going to be the case. Funds and ETFs and things, they don't sell on their own unless you're really, really advertising. Dimensional, we don't advertise. We work with professionals. We work on referrals. People know our business. We think that, it's a very complicated story. And the more interactions we have with any entity, whether it's a big institution or whether it's an advisor or even an end client, they're going to actually pick up the story and understand why we differentiate versus an index. And that's an important part of our kind of process. So what we've seen is just that. The advisor and institutional take up in the ETF side is the high 90 percentile. The individual retail customer might on occasion pick up a dimensional ETF, but that's not been the case for the business.
Given that what you do has been wildly successful, I mean, it really has. As you said, your funds and ETFs have beaten the indexes, while the traditional active funds and ETFs have dramatically underperformed their benchmarks and indexes. Why isn't everybody doing what you do?
Wow. I ask myself that same question all the time.
I don't blame you. I'm thinking about starting one. No, I'm kidding. I'm too old.
Yeah, no. I mean, but look, the history of financial services, whether it's money management or insurance or whatever, is it's always been a product push business. People don't sit around and say, "Boy, I bet your markets are efficient. I wonder if anybody would design an index fund." No, you got to go out and convince people, and there's always a shiny penny somewhere. And what we do, it's sensible, important. I wouldn't call it sexy, I mean.
Well, it is if you're the end investor.
Well, at my age, that's about as sexy as it gets, So anyway, but I would rather think, look, when we started the firm, next month it'll be 44 years ago, and in my spare bedroom in Brooklyn Heights, and we were just happy to have enough money to have positive cash flow for the firm. To go from that to $800 billion under management, I think that's progress.
Yeah, and I would just,
right.
And I would add also, I think it's a trust business, and David brings this up all the time. You build trust by setting expectations and meeting expectations over and over again. And I think what Dimensional's done and why we've been successful, and I've been around for a long time, from $9 billion under management to $800 billion. It's been that we've done that, and we've done it methodically. And I think it's a story that, we don't, as Dave said, we don't push it. We don't advertise it. We let people come into our circle. We let them look at the information, at the data, the history, and the kind of body of work, the returns that have been delivered by Dimensional. And we like people to come to a conclusion that they would want to work with us and work, in a way that is going to be a long-term relationship that we can build on over time with that trust. So I think that's the kind of the I'll call it the slow build. I mean, it's been methodical, but it's been, it's rare that I see, and I've told David this a number of times, when it's rare that I see somebody who actually comes across the information and we present it in that way that they don't kind of nod their head and say, I get it. Now, there might be reasons why they don't do it, but it's not because of a theoretical or kind of a lack of understanding. So it takes time to get people to be aware and knowledgeable of that. And hopefully, again, the film is one of those things that maybe is a creative way to do that.
The title of the film actually goes to is this concept of tuning out the noise. How do you manage to tune it out of your lives, your family's lives, your friends' lives? We tend to want to check up on our portfolio. We tend to want to watch CNBC and Kramer's bombast. How do you and your friends stop? And how do others stop paying attention to all this stupid noise?
Well, investing is complex and uncertain, and it's really, in some ways, it's about managing that uncertainty is what it's all about. And if you have a well-grounded approach that you say, okay, the markets are going to go up and down, I don't think anybody should be surprised at that. But over the long haul, there seems to be an order that comes out of the chaos of the markets that's very reassuring to people. Over the long haul, stocks in the U.S. have done about 10% a year over almost any long kind of time period. That's a pretty good return, and that's just that's available because you can buy market portfolios.
Yeah, but David, right now we've got all of this fear as we're recording this,
right,
in the markets where people. And I'm asking for this advice personally. People like my wife are sitting around watching the news, going, "I think we should sell."
Because right now, clearly, there's a lot of anxiety, and there is a way of measuring the amount of anxiety in the stock market. There's this VIX index, which is just a volatility measure. I don't want to get in. And that has spiked up, indicating that there is more uncertainty now than there had been a few months earlier. I mean, it's still well within the bounds of that we observe from time to time. But, anxiety isn't restricted just to stocks or bonds. I mean, it's life in general. I mean, part of the anxiety about the market is people are worried about the economy. And I think it's perfectly reasonable in times like this to stand back and say, what should my long-term investment approach be? And, connected to what your personal situation is. And, it may be time to rethink investing, but it shouldn't be based on a short-term trying to time the market. I mean, I have anxiety, so I'm going to sell stock. And it may feel good, but being out of the market is one of the most costly things you can do. And one of the things that's disturbed me the most over my 50-some years in the business is every time the market dips a little bit or the anxiety level spikes up, people want to sell. Then they get out of the market and my gosh, the market, instead of going down, it goes up. Then they go, hey, I can't get in the market now. The train's already left the station. So you have, the cost of acting on acting on anxiety can be really quite high. So step back, take a relief, and finally, you got to have an alternative. If it's not investing in the stocks in a meaningful way, where are you going to go? I mean, you look at bonds. There's a lot of anxiety over inflation.
Look, no matter how long you're around, you're always going to have those emotions. It's not easy. You got to recognize that and know that. But we used to have a saying that was, I can have an opinion, but God forbid I invest your money based upon that opinion. And that's always been kind of my kind of fallback position when I think about this stuff. I read the paper, I watch the news on TV, like everybody else, and I've got an opinion. And I get nervous, I get scared, I get giddy, I get greedy. I just don't act on it. And I think for me, like as an old, and Dave and I are big basketball fans. It's kind of like, if you're a free throw shooter, you got to go in the gym and shoot 100 free throws a day. so that when that moment comes and you're out in front of 10,000 fans, you got to make a basket, you fall back on this repetition. And so I think in the investment world, you have to fall back on the statistics, on the data. You have to fall back on information that's going to put you in a comfortable spot so that you don't react emotionally in the moment. And that's, I think, what David just said as well.
So basically, tuning out the noise is trying to turn off the emotions and concentrating on the data.
Yeah, concentrating on stuff that makes sense. I mean, the thing about noise is it's on average, you have a tendency to think of it, it adds up to zero. So you go through all this anxiety and you end up, no better off and worse off if you acted on it. I'll just conclude with one of the things that people don't fully appreciate is the miracle of the stock market, public markets like in the U.S., where you have a lot of transparency, a lot of trading volume, and you have these very sophisticated professional investors on both sides of the trades. They're trading with each other, and they don't trade unless they think they're getting a good deal. So what that means is, even with all this anxiety going out there, the market mechanisms are working, and people aren't going to come in and invest unless they think they can get a fair return. And that's the thing you have with the stock market that you don't have in your personal life. Is there's plenty of reasons to have anxiety about the economy or whatever, but the stock market itself, is pricing all of that out.
Yeah, then you look at the long-term returns. There was a line in there by Roger Ibbotson in the movie that says the rule of 7. I mean, the historical returns on the stock market has been 10% for the last 100 years. And if your money doubles every 7 years if you get 10%. So, things like that I think are helpful for people to back up. And in the moment they see this activity, but if you kind of pull back from that and see longer term trends, longer term charts and so forth, you're going to see a much, much smoother ride. You just have to, again, tune out the noise and avoid the emotion that's going to make you react. That's the important part. Well,
it's a great movie. It's available right now to everybody on YouTube. I've noticed that well over 250,000 people have already watched it. It's a terrific film by Errol Morris about the science of investing. So if you want to learn a little bit more about this, and we know you do because you listen to us, go to YouTube and watch the movie. Okay?
Good.
And gentlemen, it has truly been an honor and a pleasure to speak with both of you. And keep doing what you're doing because we need folks like you.
Thanks so much.
Thank you very much. Yeah.
And you keep doing what you're doing. Things, podcasts like this are really important.
Yep. Yeah. Thank you all. We really appreciate you being a part of it. And thank you all for listening. We do this almost every day. If you want to get in touch with us, just go to talkingrealmoney.com. You can ask questions there. And, of course, you can listen to all of our 1,600 podcasts or so. I'm Don McDonald. Take good care of yourselves. I'll be back really soon talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.